Amazon shares stumble as investors show more signs of impatience with the company's AI investments. While the online retailer's cloud computing unit recorded lower than expected forecasts for its first quarter revenue and profit. Its share price is set to open over 3% lower once that opening bell rings. Russ Mould is investment director at AJ Bell. Russ, it's not all bad news at Amazon as its retail business is still performing really well. So do you think the investor reaction has been a little bit overblown?
It's not just the retail business that's doing well. I mean, we know the cloud business is still a money machine, and the whole company made more money in 2024 than it did between 1997 and 2020 combined. So it's still absolutely buzzing. The challenge that you have as a shareholder, it's on more than 30 times forward earnings for 2025, and it's piling a huge amount of money into the cloud business, into AI, where the returns are still somewhat difficult to forecast and to predict. And so I think that's what spooked investors a little bit. Combination of high expectations, high valuation, and just those lingering doubts still about AI, whether it's related to DeepSeek or competition from more established players.
Well, let's move on to cosmetics now. And L'Oreal, the giant French cosmetics firm, looks to have been hurt by slowing demand in China. Should we expect more companies to suffer the same fate?
Well, you and I will clearly have to try a little bit harder here, Ramzan. But yeah, I mean, I think the China issue here is not one that's new by any stretch of the imagination, but it has weighed on the fourth quarter sales numbers from the company. And again, the challenge that we have is we have a business that we know is well run, has a strong competitive position, provides great returns on capital, but comes with a very high valuation in the high 20s. So again, there isn't much room for disappointment, and that's probably as much as the reason for the share price weakness today as anything else.
There was also a warning today from the high-end car maker Porsche. It says it's facing higher costs for new models, but what do you make of its strategy to pivot back to combustion engine cars?
Gosh, yeah, back to the future. I mean, it's been a big week for companies almost turning a little bit away from renewables and pivoting back to the old hydrocarbon internal combustion engine world. We saw Equinor of Norway, the oil major, do a little bit of that this week. We're all waiting to find out what BP's Capital Markets Day has got to say. And now a car company saying, actually, electric vehicle demand not coming through as quickly as we would hope. Therefore, we're going to make sure that we're not going to miss out on what's available still in internal combustion engines and plug-in hybrids. So that's why Porsche is doing that. The bad news is big dent to its roadmap, big jump in research and development spending, margins coming under pressure. The shares have actually recovered some of their early lost ground.
Now, we've also got some news of a deal. Legal & General is selling its US insurance business to Japan's Maija Yasuda for $2.3 billion in cash. LNG shares touched a 12-month high earlier. What do you make of this deal?
Deal is being well received by shareholders. The share price has done nothing for 5 years, and boss Antonio Samori seems keen to shake that up. And one way of doing it, focusing on core strengths and returning dollops of cash to shareholders.
That was Russ Mould there from AJ Bell. Don't forget, you can get more videos on Reuters.com.